We've been very pleased with the performance in the first half, which has tracked our expectations. Let's remember that 2016 benefited from a one-off restocking of the midstream, which helped drive our revenues. And against that backdrop, our revenues for the first half of this year at $3.1 billion are down around about 4% versus the comparative prior period. However, what's most pleasing is that EBITDA, up to $786 million for the first half, is actually up 3% despite those lower revenues. And that's really as a combination of lower mining cash costs, so an improvement in our unit cost position against last year, as well as greater efficiencies in our indirect spend. So in the first 6 months of the year, we sold 18.4 million carats, up 7% over the same period last year. Now, part of that is as a result of lower value carats that were carried over and sold in the first few sites as a result of Indian demonetization holding back demand for those same stones at the back end of last year. We sold at an average realized price of $156 per carat, which is down 12%, but again, because of those lower value stones that were sold. And our index price is up in the order of around 4% over the comparative period last year. So Indian demonetization did impact demand for lower value stones towards the end of 2016, and we had been uncertain around the impact in the first half of this year. What we've actually seen is a much faster recovery in the Indian market, and indeed we've seen those lower value stones that were held over for sale effectively be sold in the first few sites of this year. So our production forecast for this year was between 31 and 33 million carats. Through the first half, we've produced just over 16 million carats compared to 13.3 million carats in the same period last year, so a substantive increase, but absolutely in line with expectations. That increase in production has been driven by a few different areas, principally a ramp-up of the Gaucho Kuei project, which has now reached commercial production, and in fact the plant's now hitting nameplate capacity, if not more, and we're very pleased with the ramp-up of that project. And secondly, a ramp-up of production through Arapa, an increase of 1 million carats roughly in the first half of this year, and again continuing the journey to bring production back up to levels that match demand, having managed production in the right way in light of market weakness at the end of 2015. I'm pleased that a number of our projects have come to fruition during the course of this year as part of a multi-year $5 billion program of investment in the upstream part of our business. So firstly, Gaucho Kuei reached commercial production in March and has been ramping up to nameplate capacity. We spent circa $1 billion on Gaucho Kuei in Canada and have material benefits both for our business but also for the local community and the country. In addition, we've also hit first ore from Cut 8 in Jwaneng, where we've also spent to date around about $2 billion, slightly above, in Botswana, and this is to sustain the future of our production from Jwaneng. Finally, there's the commissioning of the SS Neoma in Namibia, where we spent just under $160 million bringing this vessel into our fleet. But we're not finished yet. Programs that are currently underway include the Venetia Underground project, and in addition to that, we've started already to turn our minds in Botswana beyond Cut 8 to the future of Jwaneng, which involves initial work around potentially Cut 9 and beyond. So this year we expect to spend CapEx in the region of $350 to $380 million, and that is significantly lower than last year when we spent in the order of $530 million. But there's good reason for that. Last year we were still moving a significant amount of waste in order to bring Cut 8 into production. That waste is now largely moved and we've hit first ore in Cut 8. We were also completing the construction of the GK project in Canada. Again, complete, and Gaucho Kuei has reached commercial production this year. Going forward, we will see again an increase in CapEx as Venetia Underground, now our principal investment project across the group, starts to ramp up in terms of expenditure as the project progresses. One of the most important things in our business is ensuring that we continue to drive consumer demand. Through that lens, we've looked again at our marketing budget, and I'm pleased to be able to say that we will be increasing our expenditure on marketing. This year, we anticipate spending around $140 million on marketing, which is up around about 20% on what we spent last year. Part of that will be through the DPA, where I'm also pleased to say that alongside a number of our partners in the DPA, we're increasing our investment to bring the total DPA budget up to just south of $60 million to be invested in our three large markets of the US, China and India. We're pleased to see Element 6's end markets start to show signs of recovery. We've seen that principally in the oil and gas area, which had been depressed for some time, and the management team there has done a wonderful job of managing those indirect costs whilst maintaining capacity to be able to meet a recovery in demand and therefore realise the benefits of their installed base. Coming into 2017, we always said we were cautiously optimistic about the market, and I think we've seen that borne out in the first half results. 2016 benefited very strongly from a one-off restocking demand from the midstream as a result of the weak second half in 2015. So we anticipated lower revenues in the first half, and that's what we've seen. But at the same time, we'd undertaken a production response in the second half of 2015, recognising the weaker market. And having pulled down our stock levels during 2016, it was necessary to start to ramp production back up again. So we set production targets for this year of 31 to 33 million carats. And through the first half, we're absolutely in line with where we plan to be for the full year, having delivered just over 16 million carats. We don't anticipate changing our production forecast for the full year, and indeed, we expect the full year's sales numbers to be broadly consistent with where we anticipated, taking into account that the Indian demonetization impact in 2016 has also brought over a number of lower value carats into the first half of this year's sales.